I think we're starting to see a slowdown in that market. Obviously, a lot of supply coming through. There's been a lot of new schemes in central London that have been consented. And there's probably simply not enough buyers for all of them at the prices that they're being pitched at. But I think in terms of some of the investment themes that we've touched on, we touched on sort of winning cities, we touched on senior living. That's all, to my mind, about buying into these long-term sustainable trends where you're basically putting money into a sector where there's some sort of following wind because of e-commerce changes, urbanization or demographics. And staying with the housing point, we think the opportunity in UK residential at the moment is actually at the lower end, at the more affordable end. And that's a sector that we've been investing into over the past few years, and we're seeing strong capital flows coming in from institutional investors, both UK institutions and European, into private renters are holding those assets for long-term income generation.
Okay, good. Rob, yeah.
Just to add a point, I think, as well on the London comment, and someone I was talking to about this last week was making the point that they think that the New York phenomenon, and I don't know if it's right, is actually like a price fear. So the dead halt thing is people just not being prepared to pay some of these prices, and which is sentiment driven. London's given itself, I think, some of that as well, where pricing is also very, very high, but also the stamp duty change, which was pretty damaging to that market. So it's saying London is now almost at that high, that equivalent end is dead halt as well, I would say.